financial engineering that has had relatively greater impact on share prices than on the broader US economy? And if there has been such financial engineering, who would be the principal architect of that engineering? And the answer to that, of course, the Federal Reserve Bank of the United States of America. Here I juxtapose for you two data series. In the black shaded area is the size of the Federal Reserve's balance sheet, measured in trillions of dollars and indexed to your left. Now you can see that the Federal Reserve's balance sheet pre-crisis, meaning pre-failure of Lehman Brothers on September 15th of 2008, was in the range of $800 billion, now around $4.5 trillion. And this, of course, is through the process of asset accumulation, QE1, QE2, QE3. We all understand these things. And the game is to add liquidity to financial markets, to try to accelerate transactional volume, to accelerate economic growth. And by increasing liquidity in various markets, that also creates more money to dump into the stock market. The orange colored line here is the S&P 500 index to your right. Today, it just zoomed back up above 2000. As I got up here, it's at 2016. Look at the startling correlation, or notice the startling correlation between the black shaded area and the orange colored line. Pretty remarkable. That looks pretty engineered. Many of us have run regression analyses. What do you try to do in a regression analysis? You try to explain the behavior of a dependent variable with one or more independent variables. Here the dependent variable would be the S&P 500. The independent variable here would be the size of the Federal Reserve's balance sheet. And I don't seem to need much more than that one variable to explain the difference or the behavior of stock prices, the movement. That looks pretty engineered. Now, some of you might say, well, wait a second, Anirban. It can't be purely engineered, because didn't the engineering, or at least the quantitative easing part of that engineering, end in October of last year? Was October not the death knell for QE, at least for the moment? Yes, it was. And you'll remember that October itself of last year was a volatile time for financial markets. You see, if you can see the orange colored line there, you can see that's October. So down and back up. There was a lot going on in October. ISIS was making a lot of news in October. That was also the Ebola month. In October, National Ebola Month. That was the month during which a nurse in Dallas who had just treated an Ebola patient who eventually died decided that she would prepare for her nuptials in Cleveland, Ohio. So she got on a plane, flew to Cleveland, high-fived basically everyone in the Cleveland metropolitan area in preparation for her wedding. And then, after a few days there, trying on almost every wedding gown available, and with a slight fever, boarded the plane back to Texas, high-fiving the pilot in the process. And so that was that month. There's a lot of reasons for volatility in October, but the markets jumped right back. And QE is a thing of the past. So one of the complaints about the current economic recovery has been that even as the economy has recovered, labor force participation has been declining. Now that's unusual. Typically what you expect is that as the economy gets better, more people jump into the labor market, begin looking for jobs, because finding a job takes effort. People want to have a return for their effort, and it's more likely that they're going to get that kind of return for supplying that effort when the economy is improving. But as you know, the U.S. labor force participation rate has not been rising during this recovery. In fact, it has been falling, most recently sitting at around 62.8%, a 35-year low. But these data pertain not to people who have jumped out of the labor market or refused to enter it, but people who are the most engaged in our labor market, the full-time U.S. worker. And what I'm graphing for you here is median weekly earnings. And what you notice here is that median weekly earnings have not returned back to their pre-recession peak. Now, policymakers are responding to this in various ways, but of course one of these ways is by increasing minimum wages in various parts of the country. And you can see the fact of recovery through many different lenses. One of them is, looking at a map. Now, this map comes from moody'seconomy.com. If you go back to May of 2009, so about 5.5 years ago, May of 2009, all 50 state economies at that time were in recession, which means that for purpose of this map, all 50 states were in red. Since May of 2009, all 50 states have graduated from the recession, no red here. No state, in fact, is in tan here, meaning at risk of recession. Everyone has forward momentum right now, economically, everybody. There are two colors on the map, blue and green. The states in blue are recovering. For instance, my own state of Maryland, but also the one we're in today, California. These states are recovering, and what does that mean? These states have not fully recovered economically. That these states are not back to where they had been pre-recession, meaning in late 2007, along a number of dimensions, unemployment rates and other dimensions, home prices. Now, the states in green, by contrast, are expanding. What does that mean? These states are more than fully recovered from the Great Recession. And you'll notice that many of the green states are right here in the heartland, the natural resource belt of America. So one of the most natural resource intensive states, if not the most, is North Dakota, of course. And we'll talk about the impact of falling oil prices on the back in shale and so on and so forth. Undoubtedly, that economy is not going to grow going forward as it has in the past several years, and that's the same is probably true for the Texans as well. But by and large, it's been a scramble for natural resources, and as I showed you that slide a few minutes ago regarding the global economy and how many natural resource-intensive economies were among the best performers in terms of growth, many of them in Africa, you see the same thing here, that it's really about natural resources. Now, this is New York State, of course. When the stock market sets new records and when upstate New York is coming back to life, New York has more than fully recovered. And then Massachusetts, which among other things is home to the American robotics industry for the most part. A rapidly growing segment of the U.S. economy. And so that's where you see the growth. Natural resource intensive states, and then east of the Mississippi, New York State and Massachusetts have more than fully recovered from the Great Recession. This state, Louisiana, is now booming. And those of you who follow construction activity, for instance, or real estate activity, might note the number of large industrial projects now under construction in Louisiana, chemical plants and so on and so forth, liquefied natural gas terminals under development. Louisiana is booming. But again, a lot of this has to do with natural resources and something that's related to natural resources, industrial production. This is a consumer-led recovery, that's all that says. This is a consumer-led recovery. It was pre-recession, it is today. Now this is important because one of the things that people tell me I should be worried about is low oil prices. In fact, I had economists yesterday telling me, a bunch of them, we have discussions every once in a while, and there's, honey bun, you need to really be talking about these low oil prices and all this means and all the bad news that's associated with those falling oil prices. So, you know what? I'm not that nervous about it because it's been a consumer-led recovery, and this makes the consumer stronger, not weaker. And even though we are now, among the world's leading oil producers, we're still a net importer of oil. We're still net. So falling prices, all things being equal, helps us to a certain extent. Certainly helps the consumer. And the consumer has been the most consistent source of growth. What has not been a consistent source of growth? Government spending, no surprise. Sequestration began at the federal level on March 1st of 2013. The Budget Control Act was passed in 2011. You'll remember the Budget Control Act. That's the act that gave us the super committee. The super committee. What did the super committee accomplish? Nothing. Imagine if it had only been an average committee. And they were, you remember, the law said, by November 23rd of 2011, you have to find a bit more than $1 trillion in cuts over roughly a decade-long period. If you don't do that, we have these automatic cuts that we call sequestration. The super committee did not accomplish anything. They did meet, but they didn't accomplish anything. And we get sequestration. Now, sequestration begins in earnest on March 1st of 2013. And many state and local governments continue to be fiscally constrained as well. Net exports has not been a consistent source of growth. No surprise. The global economy has been pretty weak. And much of the world actually weakening. More difficult for our exports to grow exports in the context of a sagging global economy. And then gross investment. Now you'll notice here gross investment on occasion has really helped to support economic growth. You see these big bars here, the 2.5% and the 2.9%. Why is that? That's mostly inventory accumulation. That's inventory accumulation. And why are these businesses accumulating inventories on occasion? To sell to these folks, the consumers, often enough. This actually reinforces the notion that this is a consumer-led recovery. This is the breakdown by industry of those 2.734 million jobs that we've added over the past 12 months. Number one category here, professional business services. I'd love to be able to tell you, by the way, that these are largely high-wage jobs. They're not. True enough, professional business services, that category includes law firms, accounting firms, architectural firms, and white-collar workers in general. But that sector also includes people who work for temporary staffing agencies, security guards, and couriers. And that's where a lot of that job growth has been, not in the high-wage categories. Second here is retail trade, wholesale trade, transportation, and utilities. This is the supply chain. This is the supply chain of the U.S. economy, the distribution channels of the U.S. economy. Many of those jobs in retail. Third is education and health services. Most of that is in health services as opposed to educational services. And by the way, that's private education. Public education shows up in government. That's just the government's way of demarking such things. But this is private education, but that's not where the job growth has been. As you know, many private institutions are now shrinking their footprint, their operational footprints. Now, this is mostly from health services, and a lot of that is from a sector called home health, and home health is one of the lower wage sectors of the U.S. economy. And then comes leisure and hospitality. And that's mostly hotels and restaurants. Now, first, that reminds us that the consumer is spending. The planes are full. The hotels are increasingly full. Hotel occupancy is up, and as is hotel construction. I'll show you data on that in a moment. But also it reminds us that we're not adding very high-quality jobs in many cases. So, leisure and hospitality, hotels, restaurants, again, another low-wage category, and many of these are part-time jobs, and part-time jobs actually show up in this, on this slide as well, not just full-time jobs. So today, Generation Y is between the ages of 15 and 34. So the central tendency of that generation is in the low to mid-20s. So under many scenarios, the bulk of them would be renters, as it turns out. In 10 years, that generation is between the ages of 25 and 44. Central tendency becomes the low to mid-30s. It's our large generation, of course. They're going to come to dominate the labor market. And a lot happens during those 10 magical years. People have children, get married, often in that order. And all of a sudden, renting a place may not be the optimal. And once you have children, probably helps to be able to drive. And moreover, home prices are now beginning to rise, as you know. Now, the pace of acceleration or pace of appreciation is not that rapid, it's true, but home prices are starting to rise. And so the investment motivation is returning to housing. Now, when I was growing up, and when many of you were growing up, you took it as axiomatic that it was a good thing to buy a home. And the sooner you bought a home, the more equity you would enjoy. These young people don't have the luxury to think that way. They've seen home prices rise, and they've also seen them collapse. They don't know. But as the housing market reestablishes a pattern of asset appreciation, asset price appreciation, that investment motivation returns. And I think over the next 10 years, you're going to see the market rotate away from apartments and back to owner occupancy. And yes, back to the suburbs. People tell me all the time, Anirban, these young kids, they love the city. They love the city. Of course, they can't drive. In 10 years, the suburbs are coming back. We'll see that play out. I think 2015 is shaping up to be quite a good year for the U.S. economy. I'm a believer this year. And that's an expression of confidence in and of itself. Because for those of us who listen, for those people that listen to economists, people get upset with economists under what circumstances. If I tell you the economy is not going to be very good, and it turns out to be good, you're not going to be mad at me. But if I suggest to you the economy is going to be good and you believe it, and it turns out not to be good, you should be mad at me. So for me to tell you the economy is going to be pretty good in 2015 is a risk. I'm much better off telling you it's not going to be good, and then whatever happens, happens. But I think it's going to be pretty strong. And 70% of the economy is the consumer, and I think the consumer is ready to have a really good run.